Good morning from Australia, Michael, and good afternoon to you in the US there.
Thanks, Vern. Good to be here.
Yeah, welcome back. We last chatted in January, and the trend was setting up in a number of asset classes, and they appear to be playing out as you predicted, or as your analysis identified, I should say.
Hmm?
Yeah, but for those who may not be familiar, with Michael's work at Momentum Structural Analysis, you established it in the early '90s after an institutional career, where you identified that that you look at things from a different point of view. A lot of people focus on price, whereas you look at momentum and the trends that it reveals, and that have been building. These trends build for a long time, and they give you a depth and a better insight into markets. And that's certainly what I've discovered in being a subscriber to your service, is the depth of the work that you do, and it's not just the depth; it's also the breadth of it is second to none. It's brilliant.
Thank you, Vern. Yeah.
Yeah.
We rely more on momentum structure, just like a price chart analysts look at what? They don't just look at the price, they draw structures, the uptrend lines or floors or ceilings. And when the price action goes through one of those structures, they trust that something's happening. I found over the years, though, that quite often price charts, which again, remember, everybody sees them. Like Joe Randall said years ago, if everybody believes it, it's not true. Okay. That price breakout signals, whether up or down, quite often can be misleading. And I found that if they're not validated by momentum comparable breakouts, up or down, and usually momentum will lead price, by the way. It was by weeks or even months sometimes, in a new direction, that is. That then the price signal is probably a trap. Okay. But so our prime focus is, again, on momentum, and we look at different time scales. So that we don't just look day to day or week to week. We look at annual momentum quite often, meaning we measure, for instance, you've got our grid sheet coming up here soon, which is every couple of weeks we put out a summary sheet of certain major asset portfolio categories, traditional type categories like stocks, bonds, and so forth. And we categorize, define what is our trend assessment, where do we go bullish, where do we go bearish, where might it go next, et cetera. But these are based on generally longer term technical factors, such as we called a top in the NASDAQ 100 as of the January close. At that point, NASDAQ 100 was in the 15,000s. It's since dropped down to 11,000. Right now, it's about 13. That was based on breakage, not of price. Price chart then didn't look bad. We're only a month off the high, but momentum had broken a major clear structure on annual momentum oscillator of the NASDAQ 100. And sure enough, price followed. S&P did the same event as of its February close. So at that point, we turned major negative on the broader, the S&P 500. And generally, this is true with most indices around the world that move with us. Some move more so than we do, some less. Right now, we're the biggest bubble. Our assessment is that you've topped the stock market in the U.S., but what you've topped is the largest stock market bubble in U.S. history. But by that, I mean that, we know the central bank went berserk. A dozen years ago, they did QEs, monetary expansion went off the page if you plot it. They took interest rates effectively to zero. We've been there for a dozen years, effectively at zero. And so all kinds of flow of liquidity occurred. Well, investors tended, not so anymore, tended to put all that money into the stock market and to certain other categories like high yield corporate debt, municipal bonds. Well, they drove the S&P up sevenfold in the period from 2009 to 2021. It's never had a bull market much more than 2 to 3-fold. Even the 1929 peak or the 2000 dot-com peak. You go back and look at the bear low that preceded those, it's nothing like a 7-fold move like we've had. Plus, it was protracted. It was a dozen years. NASDAQ 100, meanwhile, went up 16-fold. Okay, so if this, quote, stock market bubble pops, and I think it's popped, and enters a bear market, it's likely to be far more real world negative than even what we saw in 2009.
Mm-hmm.
You know, where the real world effects hit everybody. You didn't have to be in the stock market. You were getting hurt. I think this is going to be monstrous. And at the same time that's going on, certain other markets are going different ways. And we argue that the best place to be on the planet right now is long gold and silver, despite their recent weakness.
Mm-hmm.
But right now, there's very few alternatives out there. In fact, if you're a normal portfolio manager, you know, and there's certain components that are sort of acceptable in a normal portfolio. That would be stock market, bond markets, things like that. And also at the bottom, everybody sort of accepts, they have over the years, that gold could be a component.
Mm-hmm.
It's been around thousands of years. Why not? Okay. Gold's down about 1.5% on the year right now in US dollar terms. 1.5%. You go find me another major asset category, it's down 1.5%. You know, so on a relative basis, you know, a good day, gold will be up on a year. Other asset categories are down double-digit percentages. So if you're a portfolio manager, you're really hurting because the alternative of the T-bond market, for example, is not an alternative. It's down more on the year than the stock market.
Mm-hmm.
It did huge damage technically to long-term trends. So, you know, gold is really, despite it being beat up recently, it got down on the year $100 or so in the U.S., $120, 30, which is, you know, still single-digit percentages for gold. It's now coming back up. We think it's going to ultimately emerge as the place to be, as these other categories continue to go down. So,
and speaking of those other categories, you mentioned that grid earlier. It's something you've introduced recently to identify the big trends. So I just wanted to touch on that, and then we'll drill down into the more bearish. We'll have a look at the bearish trends, but and we'll come back to the gold and silver side of it. You know, so we'll identify where people shouldn't have their money, and where they should be increasing their weighting to benefit from what this unfolding of this bubble is going to be, which is going to trap a lot of people. I just sent something around the other day about Jim Rogers. You were saying it's going to be the worst bear market in his lifetime is what he's looking at.
Yeah. I fully concur. And there's a few other asset managers out there of note and size hold the same view and have expressed it in different ways. Ray Dalio, for example, Jeff Gundlach, you know, they see this reality. And they see the Fed as a false temporary deviation.
Absolutely.
The Fed has effectively pricked their own bubble. They created the monster. And then when they came in with these rate increases, the monster suffered more than other asset categories, which makes sense. Okay, now that the bubble is unwinding and headed a lot lower over time, probably the next year or two, they're going to have to reconsider what their trajectory is. And there's already a lot of economists out there who are, you know, not pro-gold type economists who are saying, hey, you know, Fed, this is a tough balancing act. You know, you got to rethink how fast you do this and how long you're going to do this because there's certain assets that are melting. Yeah, and once the Fed gets that message, they're going to have to, shift policy again. All credibility is gone at that point.
Well, I think it went a long time ago, but we'll look at this. We'll have a look at the grid now. You getting it up on screen?
I see it. Yeah.
So with the stock market, you know, you've broken it up into the major indices, the S&P, the Nasdaq, emerging market, and then the major stocks within there, the Amazons, the Apples, Microsoft, and the real estate sector, and they're all in a bearish trend. You know, now people who are just listening to the daily news would see there's been this recovery on Wall Street of late, but it's really just a typical bounce in a bear market, a secular bear market. So this is not uncommon that you have this sort of recovery bounce as people go in denial. Bonds and debt, you know, which is your bond market, your interest rate sensitive markets. Well, again, being in a bearish trend means that those markets are anticipating much higher yields to come. And I think that's where we'll see in the high yield stuff, especially where you'll start to see the defaults that didn't occur in the pandemic that should have occurred. are going to start coming through as these zombies get caught. And then we move into the other bear market you're in is the crypto market, and that's by the blue chip crypto Bitcoin. Again, people see a recovery there, but and I think it's just been this illusion that they say it's a non-correlated asset with shares, but I think that was all that got thrown out. That idea they went down with the S&P or the NASDAQ as well, because it's part of that speculative bubble, the crypto side of it. Sure. But the bullish one is obviously we're looking at you got the gold and silver markets there as being the haven to go to for the remainder of this decade at least. So, but I'll start with the bears first, and just to show people the depth and breadth of your analysis. We'll look at the S&P. This is from the chart you did this morning, or you sent through on the weekend. So it was. If you want to just walk us through this, what this is showing us in the near term.
Yeah. This goes back to late last year when the S&P made its peak up there above 4,800. These are weekly price bars on the top chart. Okay. And we overlay two different moving averages there. One's a 3-week moving average of price, and one is our proprietary weekly momentum average, which is based on momentum readings recalibrated to price equivalence. Anyway, it's a complex thing, but it's proprietary. But we use both of them. But the chart at the bottom is a momentum oscillator based on where those weekly bars are in their relationship to how much above or below the 3-week moving average, which is plotted in red on the top chart. And you can see the market gets above it and gets below it. So when you put the oscillator there, you can see the zero line, and you'll see we get above it, we get above it and below it, so forth and so on. Now, over the last 2, 3, 4, 5, 6, 7, 8 or so weeks, this is as of Friday's close, which you see here, those readings have been going up, the momentum readings. And actually, at the arrow on the price chart, in the mid 3,800s on the S&P, we put out a bullish signal report. It said, okay, we're going to give a counter trend rally that is different from any of the rallies we've had this year. If you look back at all the rallies this year, they've been pretty fierce in price, but they quickly fail. They last 4 bars and then they melt. Okay. This one needed to last longer for the purpose of, like you pointed out, to make people feel like, hey, this is good. Everything's fine again. Because not that it went up so much in price, but it sustained. People felt comfortable. They thought, oh, it's going to fail again. And it didn't fail. Well, we think it's going to fail. It's quite possible with high we just saw today, which took out last week's high, but then closed down. We ever crossed that momentum action back below the little red line we plotted there, which is like a ceiling of the prior couple of months on that momentum chart. Yeah, you took out all those little highs in the last couple of months 2 weeks ago. Then last week stayed above it. If you close this week out, basically down in price or almost unchanged in price versus where we closed last week, which is around 41.50. Okay, 41.40 right now. You're going to close below that red line on that momentum chart. So if this week stalls in price and just flutters around up here, that momentum chart is going to start to break down. At that point, we're going to suggest to people, okay, I hope you enjoyed the bear market rally, but don't hang around. It's likely to roll over again. And we have some big numbers below that will, well before you get back to that June price low, which is down on the mid 3,600s. Way before you get there, there's some other numbers below this market between where we are now and that low that will say, okay, we're not going to hold that low. Price doesn't tell you that, but we got some momentum charts that say, no, you get down too far off this recent high and kiss that June low goodbye. We're going to a new leg. So that's what we're watching is a potential rollover of this bear market rally.
So we could September or October could be the nemesis again,
or maybe even this month. But you're quite right. Probably looking out to September makes more sense. That at that point, people say, "Golly, it really failed." Again.
Yeah, it didn't work. And this is from your weekend report, and you called this your wet noodle chart. If you could just walk us through that, please.
Well, a lot of people use momentum indicators that they get free on their quote screens. MACD, moving average, convergence, divergence. Our RSI, relative strength index. These have been around. They're basically on everybody's screen. Okay. And they look like that bottom chart. They loop up and they loop down, and they're not so much structurally oriented. They're looping like a wet noodle. Okay. So the reason we emphasize structure, as on the previous chart, is when you break a structure, it's like breaking a dry noodle. It makes a snap. Okay. You get your action right away. Okay. A wet noodle is more or less, things aren't looking good. Oh, things are looking good. Okay. And generally it warns you that probably soon it's going to go down, or probably soon it's going to go up. Now, what we've circled on the price chart are 4 different points. Actually, in the momentum chart at the bottom, there's 5 points that are circled. I forgot to circle one up on the price chart, but every time you get about 2.5% down in terms of the weekly rate of change of the 3-week moving average, it's dropping. You get 2.5% drop in the 3-week average. That gets you down to that low level on that momentum chart, meaning you're pretty oversold. Okay, be cautious. You might get a rally. Similarly, if you get about 2.5% over, get cautious about being bullish at this point on a short-term basis. It says, hey, this weekly rally could run out of gas here soon. So Friday's close last week produced a rate of change reading that put you up in that zone of caution. And that's all this thing says. It just says, okay, you're in a zone of caution. Don't be beating your chest. Get cautious. If you made some trading profits, be ready to take them. So that's what this indicator tells us.
So, another sort of little bit of a warning signal. And now we move on to the crypto, another major, an asset class that's sort of just come in the last decade. But you've got some momentum structures on that as well.
Well, it's, this is a fairly intermediate trend, 10-week average. We also run quarterly momentum measure versus 3-quarter average and long-term stuff. But this chart's been pretty helpful. We turned bearish in the mid 46,000s back in late last year, and then again in the mid 30,000s in May of this year, 2 different levels based on some other indicators. And we thought it would drop down to at least 22,000. Well, it dropped further. It went down to 15,000, give or take, either side of it. But you'll notice that the price high on this beast here was in late last year, November or so. Well, the S&P made its price high win in December. So there is sort of a correlation now, and I wouldn't count on it lasting, but there definitely has been fairly decent correlation between what Bitcoin's doing somewhat week by week and what the stock market's doing. So sure enough, what's happened? Now, this chart here is 2 weeks old, by the way.
Yes.
In other words, there's one more weekly bar that would be there, and then this week. Okay, so it's gone up again. It's hung in there on this rally, just like the S&P has. Hasn't been a 2-week rally for the S&P. It's been a couple of months of rallying off of a June low, just like Bitcoin. We suspect this rally in Bitcoin doesn't have staying power, and will have another drop. But when we look at our longer-term stuff on Bitcoin, longer-term trend metrics, we suspect that if you go down one more time and take out, for instance, the recent lows either side of 20,000, that might be the low.
Okay.
In other words, we don't think this is going to sustain for a couple of years. We think this guy could separate from the U.S. stock market. But after all, he's been beat off the page. He's not going to zero. Okay, I don't buy that. So what we're looking for is a low, but right now I don't trust this rally in the cryptos. I think it won't sustain, and it likely will produce yet again a new low. That's when we're going to get interested in trying to define another turning point.
Yeah, that will be interesting, because I've been reading a lot about this, some of these insolvencies, these bankruptcies, and the discovery that may have to go on with preferential payments, especially to Tether, and that may open the books on Tether. And who knows what could come out of all of that. So I think with cryptos, it's watch this space. I think there's a lot more to layers to be wound back on that. So here we go. And this is something you've made a distinct point of, is that commodity inflation is not what gold is all about. So if you just want to do that distinction for us, please.
Well, this goes, a lot of people have said about gold recently when it's dropped since its March high, which was nicely up on the year, and then it got down on the year about the same distance. While gold was going down for that 4 or 5 months there, commodities were firm. Okay, people say, well, what's wrong with gold? It's supposed to be an inflation indicator. Why? It's so weak, it doesn't reflect commodities. Well, they got their head screwed on wrong. First off, history doesn't prove gold correlation to commodities. Commodities are generally lagged to gold. Even in the late 70s bull market, gold made a low in August of 1976 at $103, and it went to $850 by January of 1980. Okay, commodities didn't even turn up and join gold until mid to late 1977. Mm-hmm. So gold had already made its corrective low and started its bull trend before commodities even said, me too. Okay. Anyway, these charts go back to 1999, and they simply show monthly closing prices of Bloomberg Commodity Index on the top and gold on the bottom. Same time span. And if you look at the Bloomberg Commodity Index, the recent, quote, inflation, which is merely where some of the river flow is now going, meaning over the last dozen years, the inflation has gone into the stock market. Mm-hmm. Free money, money supply growth, all that river flow went where? Not in commodities. As you can see, since 2008, when Bloomberg made its high up there, it's trended down through late 2020. Now, during that same time, what has gold done? Broadly speaking, it's trended up. Okay, so that correlation doesn't fit well. Gold made its bear market low after its 2011 high, made a low in late 2015. And if you'll look at that Bloomberg commodity chart at the top, you'll see back in 2015, mm-hmm. it was down under 80. Yeah, there's that low. Mm-hmm. Mm-hmm. Okay, it tried to bottom with gold, but didn't. It went sideways for a couple of years and then collapsed into 2020. Mm. October of 2020 is when we issued a major buy signal for commodities. But at that point in October of 2020, gold had already doubled. Gold in the summer of 2020 had hit 2070 in price, US dollars. Mm-hmm. So gold had already had its doubling, and commodities only then woke up. So to try to correlate gold with commodity prices is a mistake. The best correlation is to look at an M2 chart, U.S. money supply, and go back to when gold was legalized for trading in the U.S. in 1975. Get one chart going back to 75, and then get the M2 chart going back to 75, and you'll see that gold has gone up 20-fold. What has the M2 chart done? Gone up 20-fold. Mm. That's where inflation is measured best. The increase of the degradation of the money unit. And gold protects against that, period. So that's where you ought to look when you're looking for inflation.
And that fits in with the thesis that once the Fed's preferred asset class, the on Wall Street, tumbles to a level where they just cannot handle the stress anymore. They're getting too many phone calls from Jamie and saying, mate, do something. We'll see another massive round of printing, which could be the tide that then takes the gold price significantly higher.
I suspect they're looking for excuses right now. Mm. One excuse I wasn't planning on is the China situation, because if frankly they don't let up, and it wasn't just a 4-day missile test, instead they hang around, that suddenly becomes a factor of much bigger than the Russia-Ukraine thing. But forgetting that, already Powell has said, especially at the last meeting, the minutes, that they're data sensitive again. Mm-hmm. Meaning, don't necessarily count on us continuing to drive this thing, the Fed funds rate vertically. If we find any data points, and I'm sure he'd like to tell you the truth, any data points that can argue to them, things are cooling off and the economy's weakening and unemployment could be in trouble. And of course, so far the unemployment issue hasn't fallen in a way that could cause them to reverse, but we suspect it will. We think that last unemployment report was clouded by a lot of people with temporary jobs, leisure and hotels work, that kind of stuff. And from what we're seeing with major industries, we suspect that's going to start hitting the employment numbers soon. So I think Powell is looking, frankly, for justification to indicate caution. No more 3/4. We're going to go to a half, or we're going to consider it month by month. When you use phrases like that, that indicates he's already sniffing for an excuse. And after all, you can't take rates down again to zero unless you get them up first, right? Okay, so that tool wasn't functional for them. They needed to get rates up to over 2% or something so they can at least drop them again. And their balance sheet, of course, they have not really cut it much. They're talking all that balance sheet stuff, but that has not had the same action that Fed funds rate has had. So, and I think what you ought to watch also is on our grid sheet at the beginning. Don't go back to it, but we also included muni bonds and high yield corporate debt. Well, if you look at the price charts of those beasts this year, they actually topped well before the S&P and NASDAQ did. They peaked back last year when the Fed said, we're not going to buy these anymore. They were outright buying ETFs of muni bonds and ETFs of high yield corporate debt, putting them on their balance sheet. Once they announced that we're going to cease buying those ETFs, those markets topped and started down. The S&P joined in early this year. But those guys have come down large percentage terms, the kind of terms that are not comfortable for the Fed to watch. So as a portfolio component, they have not done well, and nor have T-bonds. So the investment public out there, the banks also, the Federal Reserve banks, private banks are linked to the Fed system. They're uttering all kinds of statements that are cautionary. Wells Fargo has, Bank of America has. And so I'm pretty sure the Fed is going to alter that course subtly, but probably soon. And I think that's what gold knows. The gold sees what we've been talking about and says, hey, first off, don't be concerned about commodity inflation. And we think there's more of that to come, by the way. We think the pullback in Bloomberg Commodity Index recently is temporary. It's a corrective process. Look at food commodities going forward. Don't look at energy so much now. But I think gold sort of sniffs out that possible next outcome. And that's why it's not collapsing. Because some asset managers realize, hey, this game the Fed's playing won't play out.
This is going to put, I just digress off here, the pension fund situation there, the underfunded, under enormous pressure because they've piled into these higher yield type offerings. And even if they say, yes, gold is the place to be, it's not going to generate an income stream for them to meet their commitments because they've got to wait for that asset price appreciation. So I just see a world of hurt for American retirees.
Yeah, and the Fed set up that potential disaster as well. And I didn't just inflate the stock market off the page where it needs to correct like crazy with all kinds of real world errors having been committed and therefore need to be cleansed. But if you run a pension fund, at least in the last dozen years, you haven't had any good yields. Where have you had to go? High yield corporate debt. At least you get a decent yield there, right? Then it's got the price risk. And so as the market goes down, the high yield corporate debt market's not going up, it's going down too. So, you wanted to get rates and you got them, but now you got the price risk. And so the pension funds really have a major problem. And I think probably in the next leg down in the stock market, we're going to start to be hearing about that.
Oh, yeah, I can see that
That's
coming.
That's going to panic the central banks. Yeah.
I don't know why people don't see that extra 3, 4, 5%, the capital risk, the capital cost that comes with, which can wipe out years of extra return. You can drop 20%.
This year, like the high yield corporate debt and the munis have been down 15%. So I mean, how much yield does that wipe out? Okay.
Yeah, probably 2 or 3 years.
Yeah.
And the risk isn't over. Yeah, we're sitting on a powder keg, Michael. Now, this is an interesting chart from the other day. The gold monthly going back the same ratios that have happened in the 70s and early 90s or late 90s, I should say. So, do you want to walk us through this one, please?
Yeah, it's just a price chart, and it's but it shows the price of gold in ratio percentage terms. So, if gold goes from 100 up to 850, that's a certain percent move. Okay, and then you go. $250 up to 1900. It happened to be those first two arrows are the same dimension, same ratio of move. So in other words, since gold got legalized in the U.S. for trading, it's produced two bull markets of the same dimension percent-wise. Well, look what's just happened. We've come up and taken out the 2011 high and gone to sleep for 2 years. In fact, that little narrow range that I've bracketed there is probably the sleepiest price range that gold has been in the entire 50-year period, 48-year period. And I know a lot of people thought, well, we're going to break down just like 2011 and have a big bear market. Well, we tried for the third time a month ago to get under 1,700 and collapse the beast. Well, at the same price level as we were in March of 2021, August of 2021 for a couple hours, and then again for a 1 day or so a month ago, we got below 1,700 and somebody gobbled it up. And I don't mean with a single somebody, but probably somebody's. And I'm going to suspect that they're large global viewing hedge funds and asset funds. People who, like Ray Dalio said months ago, quit looking at the price of your stock. Look at the underlying value of your money unit. And it's degrading. And guys like him realize that, hey, you know, where do I hide in a degrading currency situation? And there's only one historical example, one historical market that provides that protection on an investment grade scale, time scale, and that's gold. And I think that's why gold is not breaking down out of that range and now has pumped its way back up. This is an old chart. It's pumped its way back up about halfway into that range. You ever go through the top of that range, just using price now, we've got some other momentum indicators that we'll say so before.
This one here.
Yeah, things like this. Then, you know, it wouldn't shock us to see just merely another replication of what it's done twice before. And that would put gold at $8,000. But we're in a different world than we were at those two prior bull markets in gold. Far more dangerous world in terms of economic consequences, other market wave effects. So I wouldn't necessarily count on $8,000 being merely another replication of the prior moves. Maybe it goes beyond there this time. Anyway, so when we focus on momentum, we're really focused right now, and this is the daily action since late last year, but especially since March, when gold surged well up on the year, closed last year at 1828, by the way, surged up and matched, in fact, marginally took out the summer high of 2020, which was 2,070 in dollars. We got 2,077, I think, in that March rally. By the way, a comment on the price. The return to the old price high that we saw in summer of 2020, gold doesn't do that at tops. When it tops, it isolates the high and never is able to get back to it and then produces a bear market. It did it in 2011 when it got over 1,900. It collapsed into the 1,500s, and the best it could do on its rallies, and it had several, was get back up to 1,790. It couldn't even get back to 1,800. We returned to the top tick. That's something gold doesn't do at tops. What it's done, in our view, is you've set up a double top, meaning a pending triple top breakout. So if this upturn we're seeing now engages, and we already see some evidence today, this chart is through Friday. No, I'm sorry, this is chart through today, but silver, comparable chart of silver has blown through its 50-day momentum structure.
I've got that if you want to have a look at that. Do you want to have a look at the silver one?
Well, let's go to stay on the gold for a minute.
Okay.
The gold, you'll see the 50-day moving average is overlaid on the price chart. And you can see there's times when you'll get above or below it, and it doesn't matter. Like late last year, you got below it and got above and got. But then since March, you'll notice the sell-off in late March landed on top of the 50-day average when it dropped under 1,900 back in March. That's when momentum dropped to the zero line back in March. Then you rallied off it. When you broke below it, you started your downward process. Now, price chart doesn't have a basing action. It's just a pattern of descending highs and descending lows. Now, you'll notice on the price chart, we broke below the May low, which was just under 1,800. We dropped down under 1,700. Look at the momentum chart now. It didn't take out the May low. It made its low reading in May and never could take it out, even though it made a new low in price. This is what we call a non-confirmation, where price makes a new low, momentum says, I'm not making it. And sure enough, ever since making that new low, we've turned, and we've got this base on momentum that goes all the way back to April, where you're submerged below the zero line. But if that bottom chart were a price chart, everybody'd be saying, oh boy, it looks like a bottom. But instead, they're looking at the top chart. And so what are they doing for the last 3 days? They're selling gold at the 50-day average, meaning this momentum chart is bumping the zero line, the red line. but it's already broken out above the base. The base was slightly below zero, the black line.
Good.
So already this chart, momentum chart, is emerging to the upside. The only thing left is to clear the zero line. And frankly, you have a steady day tomorrow, you'll go through the 50-day average. Now let's go to silver. It's the same set of charts, daily action since late last year, including the March high of this year. And then a momentum, which measures the daily bars in their relationship to how much above or below the 50-day average. Same moving average. Same story. When you made your lows in July, below the May low in price, momentum didn't agree. And momentum at that point was making a third wave low. You had a drop after the March high, then you rally, then another drop, and another rally. So you have 3 waves down. Usually 3 is all you get, by the way, on momentum. So you made the non-confirmed low in July. Price thunderbolted out of that low in price. You shot from like $18 over 20 in a heartbeat, couple days. Mm-hmm. And momentum shot up and broke out above the upper end of the black line, which defines all the momentum action going back to April. So momentum actually is broken out of its base. But we acknowledged that the 50-day crowd, just looking at the top chart, would probably sell the 50-day average. And sure enough, last week they sold it and they sold it and they sold it. Think of the heroes. Okay, well, today blew it out. You closed well above the 50-day average today. So even the zero line on momentum has now been overcome. So in our assessment, this intermediate trend indicator says the trend of silver is probably seen its low. You're headed up now. Now, there'll be problem areas on the way up for sure. You'll have pullbacks, but I think the net trend direction is now shifted to positive. And gold is probably a day behind. Gold close over its 50-day. It's going to say, I'm in too. Okay.
Yeah, because you then do a relationship to, hang on, I'll get it here. I've lost my little arrow. Where's it gone? Here it is. This is the silver gold weekly, the spread.
And this, I think, is probably the most important chart. What this shows is the weekly closes of the silver. Now, it's not daily, weekly. Okay, this goes back to late 2019. And if we recall, in the March 2020 sell-off, now this is a spread chart on top, meaning it's the price of silver expressed as a percent of the price of gold. Mm-hmm. Back there in late 2019, silver was trading at about 1.2% of the price of an ounce of gold. And in the March sell-off, silver dropped more than gold, so its ratio to gold, its percent relationship dropped, the spread dropped, like the price of silver. It dropped at the same time. And shortly after that low in March, in late April, early May, that spread chart, the bottom chart, which measures what? It measures the weekly closes of the spread in their relationship to the 10-week moving average. It broke out above a downtrend. And sure enough, we're talking now the month of May, it broke out, the momentum chart of the spread. The spread was already going up then too, but the momentum broke out over a clear structure. A few months later, silver went from like $19 to 30 in price. This spread chart and its momentum broke out first. They gave you a warning that if silver is shifting its relative performance to gold, this time scale, watch out, price is likely to join in. And sure enough, both the prices, silver and gold, exploded, but silver far more. Now, the top chart again, the spread chart. In the rally that peaked in January of 2021, now at that time on a silver chart, we don't show it here, the price of silver was actually marginally above the price that it saw in summer of 2020. Silver got up to close to 30 in August of 2020. It actually traded over 30 in January of 2021. But at that point, silver reached its peak on the spread chart in relation to gold. And what do we have for the last year and a half? A declining pattern of readings on the spread chart and a declining pattern of readings on the momentum of the spread. So they both have stayed in a negative trend mode. Now look at the spread chart again. It dropped below the last few months, has dropped below the lows it tried to make there back early in the year at around 1.24%. You'll see it tried to make lows. We burst below that on the spread. Look at the momentum chart. It did not make a new low. It refused to make a lower low than it had in 2021. And now with the recent upticks in the spread, which aren't really that impressive when you look at the top chart. But on the momentum chart, you have developed a very clear overhead structure. This is why we emphasize the word structure on momentum. If you saw this chart, you too would have plotted the red line, because you can see this repeated number of highs up there, 3 in fact, going back to last March of 2021. Everything was below that red line. 3 separate momentum up moves topped at that red line. We're now approaching that red line again. Right now, the spread of silver, and this is as of today's close, is at 1.15 something percent of the price of gold. That spread, if it closes at 1.18%, the circle on the spread chart, that momentum chart is going to break through its ceiling. So momentum is going to register a huge breakout with a marginal further gain in that spread. So this structure is very big, it's very wide, and it's followed a year and a half of silver underperformance. So once it uncorks itself, expect some upside ventilation to occur. And it wouldn't shock us if it's something as impressive as was the summer rally in 2020, which followed again, what? The momentum of the spread broke out first. So this is an indicator we're really focused on.
And I know you're more bullish on silver than you are on gold. You think silver has more upside than gold. So if you had $100,000 to invest, would you do 50-50?
No, I'd go entirely with silver.
Entirely with silver, yeah?
If you go back in history, since, let's say, 1980, and look at where silver's been as a percent of the price of gold, there was one time it was at 6.5% of the price of gold. It's back in 1980, that big bull market. Since then, it's twice been over 4% of the price of gold. So 3 times in the last 40, 50 years, silver's reached a level on a spread relationship to gold where it's been more than 4% the price of gold. So it's not like an unusual thing, okay? Well, if that gold chart that we showed earlier ever went to that 8,000 level, in other words, you just produce yet another bull trend in gold that replicates the ratio that it did twice before in the last 50 years. You do the math on where 4% might be, or even 3% of $8,000, and tell me what price that is per ounce for silver. It's off
240 to 320.
Yeah, that's tenfold of where you are now.
10 to 12-fold.
So if the silver-gold ratio shifts back to positive, which we think it's about to do, then we would emphasize, watch gold, because it's the mama. And if it ever breaks out above those old price highs, the whole world's going to get bullish on gold again. We'll have numbers well before that. I mean, get back up to above 2050 again. The world will turn bullish again and say, gee, we're sorry we didn't believe you, okay? But silver's going to vastly outperform gold. So that's where our focus would be, is on silver versus gold, but realizing that silver, while it behaves like a wild child, on the upside, it behaves like a bullish wild child.
Those ratios, when you put it in that context, the 4% of the pricing, and I think we showed that in January. And so we finish off here with the iron ore miners, and this is from your report on the weekend. In sum, this is a struggling trio in our view. If they decline, it would be best to connect that to economic trends ahead rather than the Fed beating inflation. So these could be sort of a barometer of the global economics or situation we're facing. And again, we'll look at those because 2 of them are Aussies. The first one is Rio.
We picked Rio. The 2 other major global iron producers primarily.
Yes.
And the reason we did this is, one, we had some requests from subscribers to look at this sector. We got bullish on this sector way back a couple of years ago when it was emerging on long-term metrics. But the point being here is that don't confuse some commodities with the overall commodity direction. This sector is highly economically sensitive, and it has had a huge move. Both iron ore has, and these miners have had huge percent gains from their very lows in 2016. See, they bottomed coincident pretty much with gold, and I look at the Rio chart, whereas the commodity complex didn't bottom until October 2020. So these guys were going up before commodities ever turned up, and don't necessarily count on them to continue up if commodities do. Frankly, when we look at these three major symbols in the iron ore arena, we see potential tops. Now, what would that imply on a global scale? Would that imply more commodity inflation? Well, I don't think it speaks to that issue. Iron ore is distinct from, and these miners are distinct from other miners. I wouldn't confuse it either with copper miners or gold miners. They could easily have an upward trajectory while these beasts top. Probably if these guys break down, and they're close to doing it, they're at levels now where if they don't turn around from their current levels, and if instead we get a weak month of August, for example, all three of these major symbols are not only going to damage some price stuff that we show on the top chart, but they're going to break some annual momentum. Now, if you look at the annual momentum chart below, it goes back to 2009. There is a 3-point uptrend. It's now a 4-point uptrend. Last month approached that trend line. You can't find such a structure on the price chart. The two lows of 2009 and 2016 are about the same level, but on momentum, it's an uptrend. So we have here is a 13-year-old momentum uptrend. If you break it, it's likely these guys are going down, not just down, but they're going to stay down for a while. And what's amazing to us is when we ran all three of these big names, they're so similar that they echo each other very well. So as a trio, we think if they do break down further, if they have a bad August or September even, they're also going to probably coincidentally indicate the next leg down in the stock markets.
Yeah, because the second one again, the BHP, it's setting up for a similar trend.
It's got a trend line, goes back to 16 on momentum, but it's as you can see, it's hit it 4 times now and it's clustered at it. Clustering on a trend line is not a good idea. It usually means you're going to go through it. Okay. Look at price chart. You don't have a good trend line. If you draw the 2016 to the 2020 low, it's way down at a much deeper level. We didn't even draw it. It's not a good line. What we do have is a horizontal line that price is balanced on either side of $50. Couldn't get above it far. Now it can't seem to get below it. So if you ever go down much below 50 on a monthly close, even the price chart's going to break structure. But that momentum chart is already sitting on structure. So any weakness this month is going to break that structure on momentum. Now you can go to Vail. Essentially the same story. Made its price low in 16 and has been going up since. Momentum made a low in 16. It's now got a 4-point uptrend line. You're hugging the line. Price chart, we put a projected channel, and what we did there is simple. Most people draw uptrends through lows. We like to draw parallel channels. And the first place we plot is not through the lows, but through the highs. That defines the angle of ascent of that market. In this case, we have 3 sets of high closes that define the channel top, where you've closed against that channel top 3 different times. If you then drop down to the channel bottom, what we did is simply drop with a parallel ruler at the same angle of ascent as the channel top, a line through that March 2020 low. What's happened since? You've dropped to that channel bottom twice. Price knows there's a channel bottom there, just like it knows there's a momentum trend line. So again, any further weakness in Vail this month or next is going to break it through price structures and momentum structures. And our bet is that this particular commodity category of stocks is not one you want to be in anymore. Gold miners is one thing. Iron miners is another. We think this will be reflective of further weakness in the stock markets.
Yeah, which flows through to that. What we're seeing in share markets now is really a temporary lull in the storm that has to undo, as you say, the greatest asset bubble we've ever seen. And my contention's been that this asset bubble, I look back through the US household wealth to income ratios, and you can plot that where it moves off. It's about 560% is about the average, the 50, 70-year average. And you see in the dot-com bubble, it sort of gets up. Household wealth sort of gets up a little bit, but then the bus comes and takes it back to that line. The US housing bubble, it took it up a little bit further, the 600%, and now and then it busted and came back, and now we're at 800 and something percent.
Wow.
US house. And so if it comes back to the 560 line, right, the maths is that gets rid of about $50 trillion of wealth off household balance sheets, which is about 200 and something percent of your GDP. And it's just, to me, it's just been, the first one was a one asset bubble. It was isolated in the tech sector, the .com, which radiated on the market. The next one was your housing market and
real estate,
and then the financial sector that was attached to that blew up. This one is just a multi-asseted one. It's you got your bonds, you got your market, your share markets, you've got your IPOs, private equity, cryptos, NFTs. Oh, it's just everything. And I think it's also multi-generational, whereas it was more boomers in the .com, and then it was sort of your boomers and then the Gen Xers, I think it is. And this one's got the millennials in it and everyone. It's a sort of multi-generational, multi-asset bubble. And that's that when you talked about the real consequences, and even people who are saying, listen, I'm not even invested in this rubbish, I'm just in good solid blue chips, are going to be impacted by it because their pension funds could get hurt, or that traditional 60-40 fund is the balance fund, as we call it, is going to get smashed.
Some people have pointed out, and they think this is positive. They go, oh, American consumers are in good shape. They're borrowing money. They feel good about themselves. No, they're not. How about if they're borrowing money like crazy? And so the lenders who are saying, look, this is great for us, great business and demand for capital, is panic money. It's because they don't have enough to cover their expenses. So they're hoping when they charge that card and they have to pay it back in next month, and but certainly by 90 days, that they're going to be better off at that point.
Mm-hmm.
And how come the subscription growth in such discretionary spending is like Netflix and online movies, so it's suddenly capped or dropped?
Mm-hmm.
That's the kind of thing that a family looks at and says, you were spending $20 a month on this online service. That buys groceries for 3 days or something, So there's a lot of decisions being made out there that are opposite what you think. For instance, the credit rise. I wouldn't cheer American Express over that or the other lenders. In 90 days, tell me how it looks. Okay.
Yeah. The other day, I overlaid a chart of the US personal savings rate with the increase in credit, and you can see when the savings rate was high, the actual credit in dollar terms fell like a couple of $100 billion. Now, as the savings rate's gone down, the amount of credit has gone up because people are depleting their savings.
These are the kind of data points that will have real bite to them. Mm-hmm. The Fed's going to have to be dealing with the ramifications of these trends that we're seeing. Mm-hmm. And those data points the Fed looks at are always lagged. They're stupid indicators. They're like 3 months behind reality. And so, we have to suffer through that. But again, I think gold knows what's going on.
Yeah, I think you're right there. It's sensing something, and from an Australian perspective, we've got the issue of the currency overlay, because you're a little bit bearish on the US dollar. You think it's had too much strength?
It's actually, our view of the dollar index is, first off, it's a very bad index because it's
more euros.
It's 57% euro, and when you add the yen, it's over 70%, just those two money units. Okay. Yeah. So, but it's mainly a euro. So if I had an index of stocks and one stock constituted 57% of the index, you'd hardly call it an index, right? Mm-hmm. Okay. But we have to live with it. Okay. Mm-hmm. If you go back to the dollar index, when gold made its low in December 2015, price of gold was $1,050. Okay. Where was the dollar index then? 98.67. Okay. Gold doubled since late 2015, between then and summer 2020. The dollar index has been largely in a range. It's slightly emerged above it, but right now the dollar index is trading around 105, 106 zone in that area. It's very vulnerable here, by the way. You get down around 105 area again, they're going to break it down. We've got a lot of momentum structures down there that will give before price says it's over. But so the dollar index, therefore, if you look at it long term, is up what? 5-6% over 7 years. And you call that a strong dollar. Not you, but in general, everybody's cheering the dollar. Yeah, it's up a lot over the last year or so, but that's within a range that was stuck in. For 7 years, it was stuck in a range from 88 to 103.50. While gold doubled, dollar was asleep. And it poked up out of the top of that range, excited everybody. And we suggest that if you get back to 105 even, they're going to blow it back down into that range, and you're probably going to attack the bottom of the range, meaning the dollar index's rally will fail. We think it's dancing. And the dollar index, frankly, on a lot of our charts looks much like this momentum chart you're looking at on this annual oscillator of Vail. It's dancing on structure, dancing on it too much, can't seem to get its foot off of it. And down this low we just made in the dollar index this month was in the low 105s. I basically circle that and say, don't take out the low of the month. Most of our momentum stuff will cave at that point.
And if there's a sudden and surprise and severe downturn on Wall Street, that could mean a bit of short-term buying of the dollar as a sort of a
I think that excuse went by the way back in March 2020. I think we did have an exaggerated situation. Also, I don't think you're going to get another crash type event in the U.S. stock market. It's a rush like that. I think you could get, another 10, 15% drop in the market. But what a crash is we define it as in several weeks, you drop 35%. And in the history of the U.S. stock market, that occurred in October 1929, 35% in a matter of a couple of weeks. It happened in late 2008, a year into the bear market, already a year into it, almost before before you hit the price lows. In October of 2008, you had a 35% drop in a matter of about 5-6 weeks. And in March of 2020, you had a 35% drop in a matter of days. Only one of those ultimately led to a bear market. That was 1929. In fact, before you even had the bear market, then you had a 50% rally back to the highs. And then you had the grudging bear market that ground you off the page for the next 2 years. 1987 crash in the S&P, which was 35% in a matter of a few days, was a buying opportunity. Didn't break annual momentum. It held it, turned up, had a whole new advance. It's in March of 2020. What happened? You made a new high afterwards. So you're not going to have a crash event in our view. You're going to have probably something that's painful, but it's not going to be of the overnight panic type stuff that we saw in March of 2020.
So you just see these layers of these waves just
a normal bear market
grinding its way down.
Yeah. You might have a double-digit drop, 15, 20% at some point, but I don't think you're going to see anything in a matter of weeks. It's like of that percent quality. No.
And this duration
of the bear market?
A year?
I don't know.
Two?
I think it could be fairly quick because I think the gold move's going to be quick too. In other words, I'm with the chaos theorist here instead of the incrementalists. Gold's been incremental up to this point. It took it 7 years to go from double its price again, get back, take out the old highs and so forth and so on. But I think the events that we're seeing shape up elsewhere in other markets, fundamentally, but especially technically on long-term momentum, are such that the wave effects that are created by these events, the bond market, for example, the stock market, and so forth, in terms of generating monetary policy, which would be accommodative to gold, for example, are going to be so dramatic that the next move up could be pretty quick. Now, most bear markets in the U.S. stock market are over within a couple of years. 1929 lasted till 1932. Dot-com bubble lasted 2 years. The 2007 top bottomed in 2009. You get the point.
Yeah,
the question is, what's the dimensionality of it? And even if you just had a 50% bear market in the S&P, let's say, and probably NASDAQ will have more because it was the leader upside, it's now the leader downside. But even if you had 50%, it's disastrous. You're down in the 2000s. That's the end of the world. The pension funds have long since generated the in-the-street type consequences. So I'm not sure about the speed of the stock market decline, but they're usually pretty quick anyway. We're already 6 months into a bear, in our opinion, so maybe it only lasts another year or two. The question is, what does it do to certain other markets? And I think in the case of the monetary metals, it generates a non-incremental rise, more of a chaos theory rise.
Yeah, I can follow that logic, and that's a great point to finish on, Michael. Is that I think we have a greater weighting in those monetary metals. I think the setup's just coming for it. And especially when you do get that downturn in markets and the Fed just buckles and starts the printing machine again. But as I think you've stated previously, that money flow or that river flow won't go where they want it to go.
Yep, they don't always dictate that. Late 70s, they provided a money flow. It did not go into the stock market. Put it into commodities and gold, especially. So
especially as the institutions scramble for performance and an asset class is performing, they will leave one behind and go to the other.
Absolutely, I think that's where we are. And we like to publish a little graph every now and then. It's a silly little graph, but it's a year to date bar graph. And it's so funny because if gold gets back up on the year, we'll publish it again. It's unchanged. Say, well, that's a boring market. And every other market's got this huge downdraft bar, 15%, 20%, et cetera, et cetera. All these categories. There used to be, some of them would be alternatives. If the stock market went down, you could own bonds. Well, what do you do as a portfolio manager? What do you do as an investor? Well, the message is out there. Sometimes it's simple as year to date. What's gold doing year to date? Well, it's down 1.5%. Okay. Compare that to your other assets. Wouldn't you rather be?
Yeah, but again, they will be a little bit later coming to the party, and that could be that chaos theory that you talk about. That there's this rush to get
the wet bar of soap, grabbing the wet bar of soap.
Yeah.
There it goes. No, I think that maybe the pullback we've seen in silver, which has been far more serious than gold, of course, the last year, and the range-bound activity in gold, which has put everybody either to sleep or in panic. The gold investors think it's no good because it's got to go up with commodities, which is a false assumption. But I think it's cleaned out enough investors such that if you do go back up, the real ambush psychologically is going to be that it goes back up. And there's a sudden scrambling in a very small market to re-own it, in which case you get that shock effect on the upside. Wouldn't surprise.
Michael, as always, fantastic to chat with you, and thank you for your insight. And I can't believe an hour's gone, and we've really just scratched the surface. It's I look forward to catching up again.
Go to the website, and we'll send out sample reports to olivermsa.com, and we'll send out samples to anybody who'd like to see some of our reports gratis.
Wonderful. Well, we'll put the website up there at the end of all this. And again, I appreciate you taking the time out to have a chat with us here in Oz.
Thank you, Vern.
Thanks, Michael. Cheers. Well, that was another fascinating chat with Michael. I chatted with him in January, and that's when he talked about the break-in structures for the US market and how things would unfold. And they are working out as per his structural analysis that he does do, in that this bear market is unfolding. And even though we're having these sort of bounces on Wall Street that give the appearance of everything returning to normal, underneath it all, the structure is breaking down. And I just find that the work he does and the depth of knowledge that he has and the history he knows of markets, just brilliant. I just love chatting with him, and an hour just went by so quickly, and we really did only just scratch the surface. We had about 13 charts there we agreed we'd chat about, but there's a heap more that he produces, and I personally subscribe to it. I think his work is excellent, and as I said, the breadth and depth of it is to me gives me some very good insight into how we should be looking at where we're at in markets. And again, this setup for the monetary metals is just pushing me much closer to making that recommendation to start buying in and having a heavier weighting in our portfolio. I thought it was interesting that he said he'd just go 100% silver, and again, the mathematics of that made sense to me, in that if the price of gold goes up fourfold, then the price of silver will go up at maybe 20-fold. in comparison because of that ratio of, say, of the silver price to gold. That's really got me thinking that if you'd like to have a look at Michael's work, I've got the screen, his site up here, Momentum Structural Analysis. And if you go along there are some sample reports you'll see there available of the sort of work that he does do. But I do reference it a lot in my my weekly writings. His weekly reports. I take on board what he's saying and where we're going, and it helps me. One of the things that just sort of helps you stay grounded and gives you the context of where we might be, and all those structural supports that he talks about. And I found that very interesting, that that last one that he brought up with the three miners who dominate that iron ore sector as a guide to where the global economy may be going. So keeping an eye on those prices of those big three, Rio, BHP and Vale, and to see if they do break down below those structures. That could be the canary in the mine for this global recession that the IMF is talking about, because bear in mind the recession, identifying a recession is a lagging event. That it's got to be 6 months of negative GDP, and then it takes a month or two to analyse that data before they'll actually announce that the recession is there. So we don't want to be wise after the event. We want to be wise before the event. So these sort of indicators that Michael is looking at and what they're showing and the way he has an insight or reading of that, I think is invaluable. So I hope you enjoyed the chat we did. It was supposed to happen last Friday. We actually did it today, Tuesday morning. So all the data you had there is fresh from overnight trading on Wall Street. So again, I thank Michael for giving us his time today to share his expertise, and I hope you found it as equally as valuable as I did. So thank you, and talk to you during the week. Cheers via the writing. Bye.